If you pay taxes this year, there's a good chance you overpaid and your accountant didn't say a word about it. I'm going to show you 5 mistakes that business owners make every single year that cost them thousands of dollars. These aren't complicated. They're things nobody talks about. Stay with me. Every year, millions of small business owners overpay the IRS, not because they're doing anything wrong, but because nobody ever sat down and showed them how the game is actually played. The tax code is 77,000 pages long. It's not written in your favor by default, but buried inside the 77,000 pages are strategies, completely legal, completely available to you, that wealthy business owners use every single year to keep more of what they earn. Hi, I'm Alex Rivera, the owner of Ceiba Accounting, and this is the video you wish someone had shared with you when you started being a business owner. Here is the first thing wealthy business owners understand that most people don't. The IRS doesn't tax income the same way across the board. A W-2 employee making $200,000 a year pay taxes on almost all of it. A business owner making $200,000 a year with the right structure, the right deduction, and the right strategy, they might only pay tax on $120,000 of it. The same income, different rules. The difference is not luck. It's not connections, it's structure, and most business owners are set up in the least efficient structure. This is usually because they picked whatever was the easiest when they started and never reviewed it again. Let me give you a real life example. We had a client, a consultant making about $180,000 a year operating as a sole proprietor, paying self-employment tax on every single dollar. We're talking about 15.3% before income tax even enters the picture. We restructured them as an S corporation and they started paying themselves a reasonable salary of $80,000. The remaining $100,000 came out as distributions, which are not subject to self-employment tax. That one change saved them over $15,000 in the first year. They had been operating as a sole proprietor for 6 years. Now, you do the math. Here's the part that nobody talks about at dinner parties. Retirement accounts are one of the most powerful tax tools available to business owners, and nobody uses them correctly. A SEP IRA lets you contribute up to 25% of your net self-employment income and up to $66,000 a year. That contribution is tax deductible, meaning that it reduces your taxable income dollar for dollar. A business owner making $200,000 a year who maxes out their SEP IRA could reduce their taxable income to about $134,000. Doing this is literally paying your future self instead of paying the government, and that is 100% legal. Listen, I am not telling you to be angry at your accountant. Most accountants are amazing people. They're just reactive. They wait for the year to end and then they report whatever happened. What we do here at Ceiba Accounting is proactive. We look at your business 6, 9, and 12 months ahead of the time. That way we can make decisions that change the outcome before the year is over, because by April almost every option is already gone. If any of this landed for you, if you're sitting there thinking nobody has ever explained any of this to me, that's exactly who we built Ceiba Accounting for. We work with small business owners who are serious about keeping more of what they earn. Not someday, not next year, this year. Head over to ceibaccounting.com to book a free consultation and let's look at your numbers together. And if you haven't subscribed yet, do it. We put content like this every single week because this stuff matters and not enough people are talking about it. Next week, we're gonna talk about the 5 business deductions that are completely legal and almost nobody talks about it. I'll see you then.